Welcome to the 2-minute warning interview series, where we're going to take a detailed but very rapid dive into what is happening and what should be happening in the energy transition in the Middle East and beyond. My name is 𝗕𝗂𝗍𝗀. I'm the director of the Energy Transition Dialogues at Gulf Intelligence, and I'm delighted to have Dr. 𝗓𝗲𝗀𝗀𝗀 with us today. She is the Chief Economist from the International Energy Forum. Dr. 𝗓𝗲𝗀𝗀𝗀𝗀, thank you very much for joining us. We're really glad to have you here.
Thank you very much, Michelle. Thank you for the invitation. Good morning.
Good morning. So I know you can talk about pretty much anything, which gives us quite a broad scope, but with 15 minutes, we're going to have to zoom in. And I'd like to focus on oil and gas companies' perspective in the energy transition. We all know that they're at a very, very interesting time. They're facing a huge squeeze right now. We've got $230 billion in impairments, asset write-offs last year alone. We have the financial and environmental argument for fossil fuel divestment. It appears strong. The rebound in oil prices doesn't seem to have had the impact that many have expected. And we also have the IEA and IPCC reports this year as well, which really have put the pressure on, not to mention Shell and The Hague as well. And if anybody isn't sure about those, then they've probably been living under an energy rock for the last 6 months or so, but there'll be plenty more details about them. So we're also looking at peak oil within the next decade, and there are many other pressure points that I haven't even mentioned. But like diamonds, pressure creates opportunities. So I'm keen to hear from you, what opportunities do you think could be in store next year, and how would you describe the outlook for the oil and gas industry in the energy transition right now? Are you optimistic? Are you concerned? Where do your thoughts lie?
Right. I mean, thanks, Michelle. It's I think it's an important question given what always happening in the world, in the industry, and also at the consumer level. I mean, we are talking about this in the middle of a crisis, at least in Europe, that an energy crisis with high gas prices that are translating into potentially high electricity prices. So I think it's really timely to have this conversation about the future of the oil and gas industry and the oil and gas companies indeed. I think I'll try to really first start looking into what the industry has inherited coming into 2021. I mean, of course, as I like to say, this is the third crisis. COVID-19 is potentially the third crisis that the oil and gas industry has lived through over the last decade, in 10 years. So before we get into the usual question about ESG targets and potential stranded assets for oil and gas, I think the first thing that the industry has inherited is for what I like to call 4 strategic fundamentals. If you are a corporation today, if you are an oil and gas company or an energy company indeed, you tend to look at your place on the cost curve. Of course, you want to know whether you are competitive cost-wise, but also you want to look at what's the carbon content of your asset base today and where you stand. And from that perspective, I think there will be increasing divergence in the approaches, in the strategies, and also because of the next, I think the second strategic fundamental is how integrated you are as an oil and gas company, how efficient your business model is, whether you went further downstream in the past 10 years, whether you have acquired the utilities business despite the squeezed investments that you talked about, Michelle, whether you acquired a renewables company, you went into the EV business, storage and batteries, which is an important, I think, business line that some companies have tried to venture in, or whether you became a major petrochemical player, because now we are seeing champions of the circular economy that are emerging. And I think the third strategic fundamental is your ability to access capital. And here, I think what will make the difference between some companies and others is their relationships with their shareholders, whether we are talking about private shareholders or government shareholders, whether they have access to traditional capital or patient capital, or even ESG now focused capital that you mentioned in your question. And I think the last fundamental is whether they have invested in technology. And for me, technology is not just a buzzword. Big data is not just a luxury today. I think digitalized trade, digitalized access to the consumer is critical to understand the consumer behavior and to manage the demand uncertainty, because that's what we are talking about going forward, whether we believe in peak demand or not. So I think the structure, the message that I want to get to you is that the structure of the industry is changing. And we can talk about some of the trends that we see, particularly in mergers and acquisitions in the industry today, that I think are quite interesting going forward.
So the structure of the industry overall is changing, and then within that we have pockets that are going to be more competitive, as you say, based on their level of integration, based on their level of digitalization and other factors as well. And that in itself is going to determine how able they are to adjust to the energy transition. So it is a very complex picture, isn't it? And then within that we're talking about IOCs, NOCs, tier 1 to tier 3, and then supporting value chains as well. So it's a very diverse picture. Just on that M&A point that you made, I'd be quite keen to hear your thoughts on that. We're seeing more tier 1 companies in fossil fuels assigning assets and operations via sales and partnerships to tier 2 and tier 3 and other entities as well. And some of this is being done to support their decarbonisation efforts. And obviously they've got deep pockets, and if their pockets are deep enough, they're able to also establish a renewables division within their company, something you just touched on as well. Do you think that critics who say, hang on a second, all you're doing is taking your environmental issues and passing them on to a smaller company, do you think that there's weight behind that? Or do you think that tier 1 have such a spotlight on them that they're doing what they can?
Yeah, I think it's right. I mean, it's a complex question. I'll try to simplify it with two thoughts, two emerging trends. I've been, I think, among the first ones in the last couple of years to raise the flag of consolidation in the industry. I mean, I think you will see going forward, and this argument has been now taken by some international organizations like OPEC, saying that you will see a concentration of the value chain in low cost, low carbon assets going forward. And it's true that as an oil and gas company or as an energy company, including in utilities business, if you have access to low cost, low carbon assets, you will be able to produce more or continue to be in the business over the next 10 years, regardless of the volatility that you will have in prices and therefore in margins. So you have this first trend going forward. So you see some of the spin-offs and selling of acreage that you see going to what you described to smaller companies. But I think on the other side, on the other hand, you have another trend that is, I think, important when you look at the trends in mergers and acquisitions over the last 10 years. So of course, the industry has been very bad in providing returns to shareholders over the last, or dividends to shareholders over the last 10 years compared to other more interesting sectors like IT and real estate, etc. But I think with the crisis that we've seen over the last year or so, and the fact that the industry has been undervalued, you've seen now some movements of capital back towards the oil and gas industry. So that's, I think, on that part we should be relatively okay. But what is happening in the mergers and acquisition space is that the average M&A deal over the last decade has doubled. The size has doubled compared to 2010. The average deal today is $350 million per deal. That was compared to less than 200 million in between 2000 and 2010.
And this is within the energy industry or within the fossil fuel industry?
And I'm talking oil and gas, E&P.
Okay.
Yes, I'm not including utilities and electricity, etc. I'm talking here just oil and gas, and the same trend has been happening if you really focus on E&P, on exploration and production.
That's quite a leap.
Sorry?
It's quite a leap.
It's quite a leap. It has doubled. And we try to look also at the premiums, because you would argue, yeah, maybe people are paying more for some companies more than others. But if you look at premiums, although we've seen a pickup in premiums in 2021 for the reason that I mentioned, companies have been undervalued, the sector has been undervalued as a whole. So we've seen some investors retail and institutional going to shop in the oil and gas industry over the last year or so, but the average premiums have declined during or after 2017 to less than 10% in the industry, in the oil and gas industry and the E&P business as well. They have been consistently exceeding 25% over more than 10 years before 2017. So here, this is also a trend that has changed in the mergers and acquisition space.
A big trend.
So we really see a shift in the valuations in the competitive landscape, as we discussed in the first question. We see a totally different return profile, a totally different cash flow and risk profile, because those who are diversifying to the utilities business, as we mentioned, etc., they are willing to take even a bit more risk, even in utilities business that is where usually players would want like a long-term stable cash flow, revenue, and margins. So Total, as an example, when it went into offshore wind, it accepted a 5-year PPA, a power purchasing agreement, as opposed to the long-term traditional PPAs that we have in the business. It's more or less the same trend that you see also in the LNG business, where companies are now willing to invest without necessarily having the long-term offtake agreement in the LNG business as well. So even the risk profile and the risk appetite of those players is changing.
You were saying then about LNG models, and that actually some deals are being signed now without the need for offtake agreements later on, such as the confidence of the market and the need for the longer term market to develop, and is within that carbon band, and we know we're all going that way, so we're keen to get involved. Do you see that same sort of appetite for ammonia and methanol as for bunkering markets, but in the long, obviously not now, but in the much longer term, the next 10 to 15 years?
Yeah, no, I think it's a very interesting question, and I think you were reading in my mind, Michelle, when you asked the question, because we are, the International Energy Forum will be launching, and actually we are launching, we just signed the MOU yesterday with a major exchange. We will announce it in due course on the hydrogen market and how this market is going to evolve. And I think your question is quite similar to that. We are thinking, of course, long term, but for methanol, ammonia, and also in a way hydrogen, all those fuels, energy carriers that are relatively versatile we want them. The world wants to use them in many applications, including, and the issue of bunkering and transportation is definitely a key one. I think it's really the high time to look into the different trajectories of these carriers or fuels, if you want to use them as fuels. So if I take the example of hydrogen, and you can apply, I think ammonia is definitely a key element of the study that we are launching with this exchange. We've seen today a very simple story. Gray hydrogen is still making up more than 90% of the hydrogen market today. It's still mostly produced and processed and used in industrial processes, so usually in clusters. You have those type of traditional contracts that you have today, but if you want to expand that, we have to be thinking about indeed new business models and new contractual frameworks, bearing in mind the industrial risk appetite to go away from the long-term end-to-end traditional contracts that helped an industry like the liquefied natural gas industry. So and the other issue is that the business model, even for hydrogen, has increased in complexity over the last 2 or 3 years, because the world is promoting, the European Union is promoting, other countries are promoting hydrogen as an energy carrier, either as a marine fuel, as you mentioned, or low carbon alternative to blend with existing fuels like natural gas. So for now, my issue with all this is an issue of scale, of course, because if you take again the example of hydrogen, the electrolysis capacity that you have today is 200 megawatts. If you want to scale it to the targets that you have, we're talking about 80 to 100 gigawatt by 2030, the 40 gigawatt by the European Union, and 25 gigawatts by Chile. And I'm not even counting the other new heavy comers like some countries in the Middle East and Africa who have access to low cost, low carbon assets in natural gas and renewables. So I think at the end of the day, this large capital investments into long life assets, and I think you are perfectly right to talk about more than 10 years, need to be de-risked. The long-term offtake contracts that we have today between buyers and sellers, they can still do the job, but they're not enough to reach the scale that the world wants. So we are thinking about, in the study, we are exploring other mechanisms. And we're also looking into the metals, some illiquid metals like steel and iron, that iron ore, that are also benefiting from these trends. So we're looking into also contracts for differences, public-private partnerships, and other types of contractual frameworks that will enable these carriers and fuels to and enable also price discovery and the finalization of these fuels, and commoditization basically of these fuels to enable them to reach the scale we want them to reach.
Because it is very much, the monkey letting go of one branch and starting on another branch. And there is that, especially in establishing the market. And like you say, there isn't a very, let's take hydrogen, green hydrogen, it's sometimes spoken about as if it's an established market and as if it's already there and it has scale and so on, but it's still such early days, and it's about building that confidence so that companies and investors can let go of one branch and be ready to go into a new one. Essentially a market that doesn't have, like you say, pricing indicators, doesn't have market structure, doesn't have export imports. There's MOUs and there are talks and so on, but there aren't robust alliances. So it's a lot to ask, basically.
I think it's a lot to ask. However, there are some low-hanging fruits and quick wins that will be unavoidable for the industry. And I think at this stage, most companies are trying to diversify as much as possible and hedge their bets wherever they are investing. And you look at the investment trends in, let's say, low carbon technologies. They have increased in the portfolio of oil and gas companies as a whole, IOCs and NOCs alike, although they are still less than 5% of the CapEx budget today. But beyond that, I think there are some day-to-day business decisions that have to be made. And I think one of the low-hanging fruits that we looked at is, as you know, methane reporting. And because we think that an immediate issue that the industry really have to deal with. And because methane is more potent than carbon dioxide in terms of emissions, and because we think that it has been a major issue that and the pressure has been piling up to COP26 in the run-up to COP26. So we launched an initiative in June that we are closing this week with a white paper that will be issued on Thursday, where we looked at what is missing today. There have been so many initiatives on methane reporting in the oil and gas industry, from the countries, from OGCI, from grouping of the companies. What was missing so far is really a widely endorsed and standardized methodology for methane emissions in the energy industry. And it's very technically challenging to measure, but at the same time, we see a factor of 10 between what is being reported by the companies and what we can observe from satellite, with satellite imagery. So we partnered with 𝗕𝗂𝗀, a leading asset observation startup, who helped us put together this methodology, and we tried to make it acceptable for the majority of our member countries, the 71 member countries, who all have their different national circumstances, even when it comes to methane emissions. So I think we reached a stage where we agreed that satellite monitoring technologies have matured. We are not just using that, we are combining top-down and bottom-up approaches. And lastly, we are using 3 different metrics to assess methane estimation. again, here, my lesson out of this was the perfect is the enemy of the good.
Mm-hmm.
I think it's urgent. We have to come up with a methodology. We will not be, it's not meant to provide the carrots, the sticks for the industry to be taxed, but it's really to enable the industry to communicate a bit better on the efforts that it's doing. So we are tackling the super emitters, we are tackling methane intensities of hydrocarbon production. We are tackling also flaring of methane in different parts of the value chain. And we really want to ensure that the industry and the member countries have what it takes to come up with a proper proposition to COP26 and beyond, at least on something as immediate and urgent as methane emissions.
I think that's a good quote to use, the perfect is the enemy of the good, because it has been fractured for so long and we've heard so much about it, and companies on an individual level have tried to do things, but that overarching level of cohesion just hasn't been there. And of course, within that, whether it's on, intentionally or not, there are a lot of black holes, and in turn, those cause a lot of damage as well. We're just going to wrap up, but I have one more question for you, and it's quite it's really just looking at the oil and gas balance sheets. You mentioned earlier about capital is beginning to move back towards the oil and gas space. We started off on a rather negative note about all the pressure that the oil and gas industry is under when I was talking about the divestment levels and peak oil and so on. And we've already spoken about the complexity of the market, IOCs, NOCs within that, and then all the different tiers, the level of integration. We've spoken about technology. We've covered a huge area, and most recently we've spoken about different contracts as well. And very critically, it applies to methane, but we're talking really about the importance of metrics in all these new markets as well. So with all that to consider for oil and gas companies, as well as the day-to-day business of producing oil and gas, I mean, is there enough cash in the kitty? Is there enough money going on, going through the pipeline for them to be able to achieve all this? Do you have a positive outlook with that?
Yes, I think there is some pessimism on the investments that are being released to the oil and gas value chain. And the IEF issued a report last year on oil and gas investments, where we, of course, we looked at the trends in oil and gas CapEx reductions in 2020 and 2021. That is quite similar to the CapEx reductions that we've seen post 2014 with oil price collapse. Usually, I mean, it's the same kind of number, 25%, 30% over 2 consecutive years. You cannot escape from that. However, I think the reason why I'm optimistic is because of that consolidation arguments that I mentioned early on, and the M&A trends that we are seeing in the business. So I think what is emerging today is a more consolidated, a more profitable industry. We've seen some inflation in service costs in pockets. For example, in North America, in NGL extractions have increased, costs have increased. The API standard has increased more than 80% over the last couple of years. But apart from that, I think overall, there should be enough to enable the consolidated players and those who have invested in the 4 strategic fundamentals that I mentioned early on, low cost, low carbon asset base, an efficient integrated business model, access to capital and relationship with the shareholders, and technology and big data. I think these players would be able to have decent margins to be able to continue to invest once we move out from these 2 years post-crisis. And this is all assuming, of course, that we don't have a new major variants, violent variants, or other black swans to deal with after this pandemic. So assuming things go back to a relatively normal stage by the end of 2022, I'm usually known from being very realistic in my in my forecasts, but it's just a matter of, I mean, it's a complex value chain, so you cannot just to normal overall, and you have it in shipping, in oil and gas, in all the sectors have been hit quite disproportionately at the same time in a synchronized way. So we cannot just get back to normal overnight, even if we don't have a new violent variant to deal with.
Well,
so
I hope
that's
those
the reason
black
why,
swans, I hope very much those black swans stay in the bushes. They can stay hidden. I think we can all agree on that.
but also the financial markets are being affected, whether we like it or not. So we are in a low interest rates world. So that's why I'm also still optimistic, but keeping in mind some of the flags that can be raised in the financial markets and interest rates, FX also movements, etc. So I think overall I'm optimistic because we are seeing an industry that is emerging, more consolidated, and hopefully more profitable.
And more innovative as well. We haven't been able to go into that too much. You did touch on digitalization and technology in general, and I hope you'll be able to join us again and we can go into that side of it, because it's such a massive part of what oil and gas companies are doing. Obviously, they have a track record in it anyway, and I think this is one of the opportunities that they can really leverage that space as well. Dr. Manali, thank you very much for joining us. We've covered so many different areas, and we really do appreciate your expertise and your time. So thank you very much.
Thank you very much, Michelle. Thank you.
Thank you.